My name is Lila Sharkawi, and today I'm joined alongside my team here. We have Young, Angel Martinez, Christopher Nesbitt, William Ma, and Hana Lowe. So in our presentation today, we'll be looking over our portfolio performance, our economic outlook, our fixed income and equity strategy, and lastly, our stock pitch. So Beach Investment Group is based on a fundamental investment philosophy that includes a client-focused strategy, research-driven decision-making, and education-oriented decisions. So for our client-focused strategy, we kind of tailor it to each client specifically. So for example, we have the CFA OC return objective of 6% plus a 3% tuition inflation rate, which gives us a 9% objective for that specific client. For our research-driven strategy, we apply related investment pieces, such as David Blitz's 2015 Factor Investing Revisited, and we also conduct our own economic and fundamental research for individual positions. And lastly, we're education-oriented. We require each student to step into leadership responsibility, and we also invest in various investing styles to expose students to different types of risk and not just the fundamental ones. I'll be now passing it on to Young to discuss our portfolio performance.
Thank you guys. I'm excited to be here and talk to you guys about our year-to-date portfolio performance. So what this chart is our Smif portfolio versus the composite benchmark. The benchmark consists of 50% Russell 3000 index, 20% all countries except US index, and 30% Barclay US aggregate bond index. So the performance of our portfolio here is consistent with our goal. Our goal is to mitigate risk and optimize return. Due to our style allocation, we might be sensitive to certain risks in the short term compared to our benchmark. This is shown through the banking failures where in March, where our return was more negative than the benchmark. Nonetheless, with our balanced approach, we would yield more stable return over longer periods of time. And this is shown through August, where the Fitch downgrade, the US debt ceiling, and the final rate hike, where we experienced less downturn than the benchmark, but also during September towards October, where fear of sticky inflation and sustained interest rate was happening, where we experienced less downturn than the market. Overall, year-to-date, Beach Investment Group has yielded a total return of 10.6% return compared to the benchmark 6% return. We've been able to outperform the benchmark by 3.6%. Moving on to our portfolio composition. So what we have here is a heat map of the categories we invest in and the stock and the holdings within each category. So for our investment group, for our equity strategy, we diversify across 3 styles, and they all follow a top-down process. So for quality, our biggest holding are Costco and Berkshire Hathaway. For momentum, we have XLE as our energy ETF and Stride as our momentum stock. For value, we currently have 2 placeholder ETF, one for our small to mid-cap value and one for large cap value. Currently, we are analyzing individual value holdings for us to propose to the portfolio. And one of them is going to be described by my colleague in the upcoming slides. For fixed income, we achieve our goal through a bond holding of short duration, investment grade, and slight positive convexity. Now, I'm going to move on to our current portfolio allocation for our current equity sector weighting. So this is how much we allocate towards each sector for our equity strategy right here. Marked by dark blue is our overweight, light blue is our market weight, and red as our underweight for each sector. Thank you, and I'll be passing on to Angel Martinez to go over our economic outlook.
Thank you very much. So as far as our economic outlook, Beach Investment Group has the thesis of a sluggish growth with a slim chance of a hard landing. showing indicators specifically for CPI and CPI's behavior over the past year. 2022 saw the peak inflationary pressures that have since decreased to its current date. This is due to the Federal Reserve's enactment of federal rate hikes throughout those years. Now, despite these rate hikes being enacted, the labor market has remained very positive. We have a strong labor market as we see unemployment rate being at 3.9%, just above what was experienced throughout 2023. And even better, when we look at our labor participation rate, we see the labor participation rate returning to its 63% that was experienced pre-COVID levels in 2019. This signals and is reflective of a healthy economy as well as a strong labor market, which spills into our GDP in terms of consumer spending. When we look into the 2022 GDP growth rates, while we have experienced taper downs in GDP, we see that consumer spending specifically throughout these growth rates has remained as a big contributor. And despite this outlying growth rate in the recent Q3, we do expect consumer spending to continue performing this way as into 2024. Now, for the overall tailwinds and headwinds that the U.S. economy will be facing in 2024, for the tailwinds, we'll be seeing continued strong employment, a steady consumer spending. As for the headwinds, we'll see increasing consumer debt levels, as well as the likelihood of excessive Fed hawkishness and potential geopolitical tensions arising around the world. Again, we'd like to remark that BIG's economic thesis is that of a sluggish growth with a slimming chance of a hard landing. Now, as far as our market-weighted risk, we encapsulate the following risks that the U.S. economy will face in 2024. Now, these risks are correlated to some degree and are weighted in terms of risk and probability going into 2024. Now, inflation will remain as the predominant risk for 2024's outlook, given that it has now reached the Federal Reserve's 2% target rate. As for the monetary risk, given once again that the Federal Reserve's job isn't done and hasn't met that 2% federal mandate, the monetary policy will continue to be a latent threat towards the U.S. economy, given that the hawkishness is still there in 2024. As for the geopolitical tensions, the Russian-Ukraine war, as well as the Israel-Hamas conflicts around the world, can lead towards a potential increase in supply chain risks, further inflationary pressures in 2024, as well as decreasing the efficiency of future Federal Reserve rate hikes in 2024. Now, moving on to our capital market projections. As far as our capital market projections, BIG makes use of in-house projection as well as S&P global model, therefore giving us a 10.6 return of 4,982 projection for 2024 and being in line with our sluggish growth rate. Now, as far as the sector applications, we will be overweighting the energy, consumer staples, as well as communication services, primarily those industries that contain defensive qualities within them. As far as the underweight, we'll be underweighting the following: real estate, information technology, as well as industrials and consumer discretionary, given that these sectors tend to underperform during a higher for longer interest rate periods that we will be experiencing in 2024. Now, as far as foreign equities, after thorough research of foreign economies, we come to the conclusion that foreign economies will face higher headwinds than those that the United States economy will face. Therefore, we'll continue to allocate our equities within the U.S. market. As far as our asset allocation, we'll be moving away from an 80-20 split for equity and fixed income respectively, and increasing our weights for fixed income, given that the yield at the current stage has made the return for the bond market a lot more attractive. Now, I'll be moving on to my colleague Chris for the fixed income portion.
Thank you, Angel. So let's review our fixed income portfolio. First, taking into consideration our economic outlook of sluggish growth, and also noting that the Federal Reserve being hawkish and looking to hold interest rates higher for longer, is also considering a potential for another interest rate hike. However, given the recent CPI information, that risk has dropped dramatically. And as you can see in our current and our forecast bond yield curve, it's relatively flat with a slight inversion. This indicates to us that short-term yields are higher than our long-term yields. Taking this into consideration, we use this information in our portfolio. The first step of our selection process is to identify risk, given our current economic thesis of sluggish growth with the slim chance of a hard landing. Next, we take a look at credit instruments that we're going to use to help minimize and reduce our risks. Lastly, we take a look at the categories that we're going to prioritize. Next, we take a look at our fixed income allocation. As you can see, we're diversified across 5 holdings. Our best performer has been our short-term corporate. We're also in long-term, floating rate, convertible, and investment grade. This diversification helps us not only achieve our short-term yields, but also in our duration of 1.5. We're still able to maintain a yield to maturity of 6.97 while being investment grade at an average credit rating of A. Comparing this to our benchmark, we can see that our duration is much lower and our yield to maturity is also higher. Overall, our fixed income performance on a year-to-date basis of our portfolio in red against our benchmark in blue, we're outperforming and overall less sensitive to interest rate fluctuations. Being allocated 25% of our portfolio, we use this to help minimize our risk and of our entire portfolio while still finding a lot of opportunities in equities. And with that, I'll be handing it over to my colleague Will.
All right, thanks, Chris. All right, so now I'll be going over our equity strategy. So currently we use a top-down approach to investing, and the main goal of our equity strategy is to minimize risk and to maximize returns. And how we achieve our goal is through investing in 3 different styles, being value, quality, and momentum. And why we invest in 3 styles is because style performance is unpredictable on a year-to-year basis, and investing in these 3 styles allows us to diversify our portfolio. So now I'll be going over our historical performance for our equity styles. As you can see in my upper left-hand corner, we have our 3 styles. And essentially all 3 styles are above the market line, and what this tells us is that our 3 styles provides us with different risk to return profiles. Now I'll be going over our equity style characteristics. So starting with value style, we assess why the market has undervalued a company and what catalysts and fundamental factors will drive the value going into the future. And currently for value, we have it split between small to mid and large cap value. And for the initial screening process, we focus on a low price to book and a beta of less than 1. Now moving forward to our quality style. For quality, we look for the economic moat of a business and whether or not that moat is strong enough to continue into the future. And for the initial screening process, we focus on our market cap above $2 billion and return ratios, operating profitability, and a healthy balance sheet, and including a company that's able to manage their debt levels. Now, last up is our momentum style. We have our momentum individual holdings and our rotating ETF strategy. For momentum, we focus on the fundamental factors that drove momentum in the first place and why those factors will continue to drive momentum going forward into the future. For our individual holdings, we use a 12-month minus 1-month return strategy as our initial screening process. And for our rotating ETF strategy, we use 12 broad ETFs that encompass different areas of the market. And we rotate the top 5 positions at the end of every month based on their 6-month return. Now going forward to our target composition. Currently, we have a 1/3 strategy equal weighted between value, momentum, and quality. And we are transitioning into a 1/5 strategy where we have value split up into small to mid and large, and then momentum split up into the individual and the rotating strategy. And why we decided to do this is because it further improves our diversification. And because value and momentum outperform over quality in the long run, an equal weighted portfolio of the two mitigate their common sources of risk and provide us with higher risk-adjusted returns. All right, moving forward to our selection process. So we start with our economic thesis, which funnels down into our sector allocation strategy, where we decide on our overweights and underweights. Then from there, we move into our style-based screeners of preference. And then after that, we narrow down the screening process using fundamental analysis. And with our top-down process, this leads us to our recommendation, which I'll be passing on to Ron.
You have about 4 minutes.
All right, so in congruence with our initiatives to overweight the communication services sector, to increase our holdings in small to mid-cap value under the 1/5 strategy, as well as invest in ESG-considered companies, we would like to present Tegna. So what is Tegna? Tegna is the nation's largest owner of Big Four network-associated television stations. Aside from broadcast television, Tegna's income streams are diversified across their footprints in streaming, advertising, and podcasts. So if you stream local news from one of its 51 geographic markets through a Roku, an Amazon Fire Stick, or Apple TV, you have interacted with Tegna. If you've watched shows such as Queer Eye, Dual Survival, or Dateline, you've experienced Tegna. With a favorable ESG profile relative to its industry peers, we recommend to buy Tegna at its current price of $15.62, which in relation to our target price of $25 per share presents a 60% upside potential. Examining the quantitative elements that attract us to this security, we are drawn to its value attributes of low beta, price to book, and price to earnings relative to the market, signaling to us Tegna's bargain pricing and defensive nature. Despite its bargain pricing, Tegna has continually delivered value to shareholders through its strong balance sheet, revenue, and cash flow growth. Moving on to our investment thesis, we believe that the market has undervalued Tegna's strong fundamentals and future growth prospects following a blocked merger. Under the deal, Tegna was to be bought in cash at an 11% premium to its market value. However, the merger was blocked by the FCC due to regulatory concerns. Since the termination of the merger, Tegna has repurchased more than $450 million worth of shares and has increased its quarterly dividend by 20% to return this excess accumulated capital to its shareholders. For capitalists, we believe that revenue tailwinds throughout 2024, driven by political or presidential election year ad revenue, as well as coverage of the Super Bowl and the Summer Olympics, present an opportunity for Tegna's stock price to drive up towards our target price of $25 per share. For context, in 2020, the last election year, Tegna's revenue grew by 27.8%. This is even more compelling to our catalyst argument, considering that 2020 did not have coverage of the Summer Olympics due to COVID. Jumping into our valuation methodology, we utilized EBITDA multiple, comparable company analysis, dividend discount, and discounted cash flow models for our valuation. We also took into account the 52-week high-low price range to arrive at our target price of $25 per share. To account for a range of possible outcomes, we also included bear, bull, and base case assumptions into each of our models. In short, we believe that Tegna is the best fit for our portfolio's needs of small to mid-cap value under the 1/5 strategy. With that being said, I will now be passing on to Lila to conclude with our presentation.
Thank you, Ronald. So you might ask yourself, why Beach Investment Group? Beach Investment Group is actually the first Smif fund in Southern California, and we were actually the first to compete in the CFAOC competition. We also have a distinctive way of aligning our portfolio. So for starters, we have a performance excellence. Our portfolio outweighed the benchmark by 2.6%. We also implemented very cautious optimism amid economic conditions by implementing a soft landing with weak or sluggish growth. We also implement risk mitigation in fixed income by minimizing risk in short duration and maximizing our returns in investment grade bonds. And for our equity strategy, we strive for optimal returns by implementing our 1/5 strategy that also hedges risk while maximizing our return. For our strategic acquisition, we chose Tegna because it aligns seamlessly with our portfolio, fitting with our fixed income and equity strategy.
Sorry, that's time.
Okay.
listening. Okay. Nice job, guys. Oh, sorry, I'll use the microphone. All right, nice job, guys. I think in the interest of time, I'm just going to jump into questions. I was a little bit perplexed by the reference to increasing fixed income to 25% when the benchmark for the policy is a 70-30. So technically, relative to a 70-30, you would be taking on slightly more equity risk by reducing fixed income to 25%. So maybe the first question is, I'm guessing you guys were looking at an 80-20, which is the upper limits, but can you just clarify that?
Yeah, so currently our portfolio before was an 80-20, and so that's what we mean by increasing
Got it.
our fixed income to 25.
Okay, got it. So from the existing portfolio, so just make sure that's clear, because I think there was a comment relative to benchmark. But I'll let others ask questions as well.
Thank you. I have a question about performance for the past year. Just can you elaborate on any changes you made during the year that you think helped generate the positive performance? And then also, as you look at it, how much was driven by your fixed income portfolio and how much by your equity portfolio in terms of outperformance?
I would say that I can just answer off here. I would say that our main driver for the first part, our main driver for our return is definitely our equity portfolio, and fixed income is responsible for the weighted return towards like that 10.6 is about 1.26% of that weighted return is more on equity than return.
I just have a quick question on how you expect the portfolio to perform. And this is kind of a hard question, right? Because no one knows the future. But if you're increasing your fixed income allocation from 20 to 25%, theoretically you're taking some of your risk budget and allocating to a more conservative stance. So when you look at the performance and you beat the benchmark by 300 basis points, 3% or more, what does that look like going into the future? It's great to look at historical performance, but I think it's extremely relevant when we start to look at future performance and what that looks like, in consideration with your expectations, with your capital market assumptions and so forth, and in addition to how you've made changes to your application. So could you give me a little bit of insight and some clarity there?
Absolutely. So that was a valid point. So of course, historical performance isn't indicative of future returns.
I love it. That's a compliance. Yeah, I love it.
Yeah.
Can you look at the camera, Sandy?
Where was I going with that? So essentially, we
Sorry, collect your thoughts.
Yeah. So.
Thank you for your question. Could you maybe clarify your question?
Oh, sure. Just to sum it up, it's basically, how does a performance profile look like going into the future? Again, consistent with your capital market assumptions, in addition to how, how it reflects now with the new changes to a fixed income allocation that's increased, which theoretically you would imagine some of the future expectation returns would be lower if the risk budget is now used in a more conservative profile, right? Or conservative stance.
So this would tie in with our economic thesis, where we believe in a sluggish growth period with a slim chance for a recession. And so the way we have it positioned is kind of like a right in between, where we do want to keep our equity portfolio bigger because we don't expect the market downturn, and while increasing our fixed income position by a marginal amount, just to have that extra protection. And within our fixed income holdings too, we invest in investment grade bonds, and so that allows us the protection to take on the greater risk for our equities.
Thank you.
I want to double that question, sorry. But do you think you can hit your target rate of return then if you're going to change this allocation? I mean, right? Is that kind of the question here? If you forecast I don't know, whatever, six on bonds, 25%. What do you forecast for the respective returns on the 75% to get you to a 9% target? I mean, especially given that you think it's a sluggish rate of return, a sluggish economic growth. It was like one of the first 2 slides, I think.
So how we constructed this was using for the S&P model. They use a very close to recession, close to contractionary period PE, and this is how we view the contraction, like the slowdown, like the slight chance of hard landing. We put this at a rate of 25, and that's a 2.5% return for the market. And for our more bullish case, where we use for our sluggish growth case, we think we're not going to go into a recession, but we're not going to go into expansionary. So we slightly up the PE based on that, and it gives a 13% return, and a combination of 75 and 25 weighting here would produce our expected return on this.
Great, thank you.
One quick one. Congratulations on the outperformance. Nice job. So just think about how your portfolio is situated today, and what sort of a regime was your portfolio before like?
I would say that I would like to take on this question. I would like to go back to performance to answer your question. I would say that under the regime I would say for us, when one of my wording is that we are sensitive to certain types of risk, and that's because for our portfolio we are heavy weighted in value, and value financials come a lot. And also with this big dip, when I look into the numbers of what was going down, it was a lot of our smaller value, smaller company ETFs, and our smaller company that got affected by this. So that's the regime that we would underperform. But overall, we expect to view stable return over long period.
So I've got a quick question, since you're talking about returns. So you guys started performing pretty well July, August, right in there. What changed? Was it something that you guys did? Was it just market?
Thank you for your question, George. And when I look into the numbers, what I feel like was happening here was, so during the banking failures, right? And I feel like there was a strong reaction because people feared the bank failures would spill over to other sectors. But thanks to the Fed action, the market kind of did a reversal and had an expansionary period. So I think when it comes to performance, we did make some slight changes, but it's more on the market itself. Like for us, like the regime, the question is like we have smaller company, so we would take a hit when financials get hit. Well, we added United Healthcare, that's a bigger company, and that kind of helped us support our price.
No.
Time for one more question.
Can I go? Anyone else? So, appreciate your responses. I'd like someone else on the team to address this question. So we see the increase in allocation, again, I'm a fixed income guy, so we're going to harp on this a little bit. See the increase in fixed income, but we see a substantial underweight in duration, right? So give me a better understanding of that rationale, and just help the committee here better understand that type of positioning, especially when you talk about soft landing, things of that nature. That doesn't mean robust growth, right? So ultimately, at the end of the day, what is it? How do you diversify away from some of that equity beta or the equity risk that may incur if it gets worse than you imagine, right? Ultimately, by underweighted duration so substantial. Long-winded question is just give me the rationale.
Okay. So our duration is 1.5, and we have it so low because we're seeing higher yields in short term, and with our relatively uncertain economic forecast and the fluctuating bond market, especially as of lately, we are looking at more longer term and more intermediate term bonds to up our duration, and so it's something we're considering and will potentially do. given various factors that we will continue to analyze. But right now, we have our duration so low because we're getting most yields from them right now.
And also, if I may add,
Of course. Please.
also, if I may add, for our economic thesis, we do feel like initially we expected another rate hike to happen. Understanding the new CPI data, we think there's a decreased chance of the rate hike really happening. But overall, in the bigger picture, I feel like we are thinking in the way that, okay, the chance of a rate hike happening is low and very decreased, but it's still larger than a rate going down. So that's why we're positioning ourselves with this current duration.
Fair enough.
Okay. All right. Thank you, guys.
So, good afternoon. We are Poly Pomona's Brown Asset Management Team. I'd like to thank you all for giving us the opportunity to present today. My name is Yusuf Hajar. I'm the current elected Managing Director of 2024. And before we get into our 24 request for proposal, I would like to bring up the 2023 Managing Director to speak about the current performance of BAM.
Thank you, Yusuf. So while 2023 was disappointing, there were some things that went well for BAM. As of most recent month end, October 31st, BAM unfortunately underperformed the benchmark by about 2.7%. There are some things that worked and some things that didn't work. Some of the things that helped our portfolio was our strong asset allocation, which added about 100 basis points to our performance. In addition, our international outperformance added 50 basis points to our portfolio, which is attributed to our investment in India. Fixed income outperformed by roughly 20 basis points due to our slightly lower duration than the benchmark. And what we want to highlight here is that going into 2023, BAM was a VAR-oriented firm, which is value and reasonable growth. And we can see here that BAM VAR outperformed both Russell 1000 and Russell 2000 value. Unfortunately, what didn't work was the overall value strategy. As we can see, both Russell 1000 and 2000 value significantly underperformed Russell 3000 growth. We learned that we wanted to stay fundamental analysis focused. We also have acknowledged and understand that the U.S. economy has changed, so we wanted to add some growth into our portfolio moving forward. Now that we've covered 2023, I'd like to pass it back to Yusuf to go over the team's outlook for 2024.
So for 2024, BAM is going to be updating their economic and data analysis. We'll be applying new learnings that we've received from the previous team and from new learnings from 2023. We're going to be building a completely brand new portfolio, which is special about BAM's team because it gives the students the ability to learn complete portfolio management process and complete portfolio management. So what we're going to do is stick with the fundamental strategy since it's been proven to work in the past. We're going to remain data-driven and we're going to use a top-down approach. We start with economic analysis, asset allocations, sector allocations, and equity analysis. Now I'd like to go into the United States economy by inviting Ray and Scott to the podium.
Thank you, Yusuf. So to begin our portfolio, we needed to decide where we wanted to invest. So starting at home with the U.S. economy, we took a look at GDP using four main components: consumer spending, business investment, government spending, and net trade. The last of which we found to have an insignificant impact and we did not consider it further. As for consumer spending, we found that income drives spending. Here we found that consumers have three ways to get that income. They either earn it, save it, or they borrow it. As for earnings, our demographic research supports a tight labor market, which will drive up wages and support that high consumer spending. As for savings, we didn't see it as a viable option for consumers to draw from, as low savings levels post-pandemic. We actually see that consumers will likely divert a portion of their earnings to replenish these savings levels. As for borrowing, we also didn't see that as a viable option, as consumers are currently at very high debt levels, and because interest rates are currently very high, borrowing becomes more expensive, and we don't see them taking on more debt. We wanted to next take a look at the environment that these consumers are spending in. So we projected inflation by considering the market composition of labor and materials and multiplying that by its forecasted growth. We got those growths from wage growth and the Bloomberg Commodities Index. Summed together, this created our inflation projection of 2.85%.
This is above the Fed's goal of 2%, so we do expect them to keep rates higher for longer, with rate cuts not coming until the second half of 2024. Consumers are not the only ones spending in this environment. We do see businesses continuing to spend in this during this time because corporate profit margins are continuing to grow. This is despite interest rates taking a little bit of putting a little bit of cap on that growth, both for capital investment and residential investment, as high interest rates lower the affordability of real estate. As for government spending, we still see growth there as well, although once again, like business, it is a little bit challenged. We do expect 3.6% growth, although political gridlock, high debt and deficit levels may prove this level of spending to be a bit optimistic. So all in summary, it is a tortoise, not a hare. The U.S. will experience slow and steady growth in 2024 at 1% real GDP. Adding on our inflation projection of 2.9, it'll come to a nominal 3.9 and a 4% GDP projection. And once again, this is due to high consumer spending, businesses and governments continuing to spend despite inflationary pressure and interest rates. Now, the U.S. is not the only place we wanted to invest. We also took a look at foreign markets, and I will pass it off to Tyler to speak on that.
Thank you, Brianna. Hello. So, when conducting our international econ analysis, we looked at, oh, I pressed the wrong button already. What do I do? Okay, awesome. So, okay, there we go. My apologies. We looked at 5 different economies. We looked at China, the European Union, South Korea, Japan, and India. Now, out of those 5, we did not think that these 4 were investment quality due to their weak demographics and rising geopolitical tensions. Now, moving on to the economy that we did want to invest in, which is India. Due to its resiliency post-COVID-19, its continued growth, its strong demographics with an average age of about 28 years old, and a government that's focused on improving Indian infrastructure, as well as continuing their economic growth momentum. So now that you know our economic outlook, what about capital market outlook? Well, to answer that question, I will invite Isaac to the podium. Thank you, Tyler.
So for BAM's capital market outlook, it first arrives with our methodology. Our methodology derives with the usage of finding the market ERP from an S&P intrinsic valuation model. We then implement the betas of other indexes to find the returns on asset classes. And for the fixed income universe, we use yield to worst to find expected returns. As such, we did have a question in mind that we came into consensus with, is cap and pricing in everything. Furthermore, current economic outlook. So for international markets, we've seen them likely to underperform. Why? The European Central Bank is still behind the monetary policy, that weak international economic growth, and geopolitical headwinds such as the Ukraine and Middle East wars. For our optimal asset allocation, it arrives via a usage of an Excel-based model that is mathematically driven and combines covariance and variance matrix with CAPM, and then it provides us the max Sharpe ratio scenario. From there, it gave us an initial optimizer max Sharpe ratio scenario of 60% equities, 40% fixed income. However, we felt like it didn't tie in with our economic outlook, especially for international markets. So we did some tactical adjustments to the max Sharpe ratio scenario, and as such, we got rid of the developed markets allocation. We remained only 5% in emerging to invest in India, and we went overweight in domestic and 35% into fixed income. Although this is a lower Sharpe ratio, we feel that this reflects a true and more accurate scenario. So what have we done with the optimizer? Well, BAM is staying home and going on. For our domestic equity allocation, our thesis was that the U.S. is still the world's most active economy, it has lower geopolitical risk, resilient consumer, which is why we increased it by 30%. For developed markets, they have weak economic outlook, ongoing wars, and weak demographic, which is why we decreased it by 20%. For emerging, we are committed to India, which is why we only decreased it by 5%. We're investing in India because it is a large and fast-growing economy, strong demographics, and geopolitical advantage. For fixed income allocation, we did want to remain in fixed income, so we only decreased about 5%. Treasury serve as an equity hedge. BAM sees cuts in the second half of 2024, rendering duration attractive, and MBS and T-bills currently provide attractive yields. So now that we have discussed over the several economic outlooks and our capital markets methodology, I'll invite Richard to discuss our domestic equity strategy.
Thank you, Isaac. So I did want to go over 2 of the biggest changes that we've made within our sector allocation.
So first, we started off by overweighting technology, as we believe that the economy has structurally shifted post-COVID-19. We also chose to decrease our underweight consumer discretionary, as we believe that relatively high inflation and higher interest rates are going to lead consumers to spend a little bit more prudently. So as a data-driven firm, we started by looking at the data, and we asked ourselves, what is this data telling us? So we went with the traditional growth versus value, and what we found that within the large cap sector, that large cap growth outperforms large cap value. Within the small cap sector, we've seen the opposite. So what does this tell us? So we took the two best performing indices, and we compared them against each other, and what we found was that large cap growth outperforms small cap value. We believe this is likely to continue due to that structural shift in the economy, which leads us to our strategy of having growth at a reasonable price. So how we're going to be implementing this strategy is going to start with our screener. So the first part of our screener, we're screening for growth metrics. Next, we want to make sure that we're not overpaying for these growth companies, and we want to make sure that they are undervalued. After that, we are going to look at some management metrics to make sure that these growing, undervalued companies are being managed well. The next part of the process is going to be to apply into our BAM 13 framework, which acts as a guide to our investment decision. So with the stocks that come out of the screener, we apply this BAM 13 framework. I know there are a lot of metrics here. However, these are just some key metrics that highlight a good business that has a positive outlook. So for this example, we use Jacob Solutions. What we see here is that it passed 9 out of the 13 metrics. To go a little further, deeper into our analysis, I'm going to invite my friend Jared to talk about it, to walk us through it.
Thank you, Richard. Jacob Solutions is a company we would like to buy. It is an engineering firm that has 4 different segments. PPS, People, Places, and Solutions, which is focused on infrastructure, renewable energy, and advanced manufacturing. CMS, or Critical Mission Solutions, which is focused on defense and energy. Divergent Solutions, which is focused on cybersecurity, data centers, and national security. And finally, PA Consulting, which consults in health and life sciences, advanced manufacturing, infrastructure, and more. So there's a few specific things we like about Jacobs, industry-specific and company-specific. Industry-specific, we have seen emerging and developing economies allocate a substantial amount to infrastructure. We also seen the rising demand for AI data centers and economies transferring into green energy. Company-specific, Jacobs is focused on infrastructure as it is an engineering firm. They're targeting growth sectors by spinning off CMS, and they're a pioneer of the green energy transition and accelerated economies to a net zero future. Our investment thesis. In May 2023, Jacobs announced that they'll spin off CMS. With the recalibration of operating segments, they have 2 goals. 1, higher profit. 2, more growth. Illustrated from the graph on top, per Jacobs will have an adjusted operation margin without CMS of 12% versus CMS of 8%. With the spinoff, we also believe that Jacobs' business segments are aligned with the segments of the future. We also view Jacobs with a high backlog of around $17 billion versus the sector average of $15 billion. And finally, PPS segment, which is focused on infrastructure, is projected to outpace the industry and in the past has outperformed the industry. So, why do we want to buy? Using a DCF analysis with a 2.5 terminal growth rate and a 10% cost of equity, we value Jacobs at a target price of $149 versus the 10/31 closing price of $133, leaving us a total return potential of 21.6%. We also view Jacobs as undervalued at a relative basis, with a lower PE and PB compared to the industry average. So we believe Jacobs reflects our growth and at a reasonable price by providing growth and value. Now I would like to walk you through our equity analysis process. First, we start with our GARP screener. Next is our BAM 13 framework. We do fundamental analysis. We document all this and come up with a buy and sell recommendation. And finally, we present this to our team for a final decision. So that's how we select stocks. But what about fixed income? Now Isaac will walk us through our fixed income strategy.
Thank you, Jared. So for fixed income, obviously, it's an important part of our portfolio. It's 35% allocation. So first, it starts out with the economy. While BAM's U.S. economic outlook shows decelerating U.S. economy, we believe that this will prompt the Feds to modestly cut rates in the second half of 2024, and also the aggressive monetary policy that has taken place could lead to a potential rise in default rates, hence we see default risk. So with this in mind, we had 3 objectives. We wanted credit quality, capture current yields in the fixed income universe, and wanted to add duration. So with this, we found that our allocation, it first comes with 50% into the ag, 50% into the ag because it meets all 3 criterions of adding credit quality, adding duration, and capturing yields in the market. And also, for BAM's U.S. market outlook is fairly close to consensus, and what better way to invest in, with consensus than going directly into what is considered the benchmark for the market. Also, this shows our commitment to the adding duration, which is why we went 25% into long-term treasuries. And for MBS, we see that they're trading at a discount. They're offered good yield, and they also have credit quality, so we allocated 50% there. And for T-bills, due to the inverted yield curve, they're offering attractive yields for a fraction of the risk. Hence, we did 10%, and also it helps us deploy cash to our portfolio if deemed necessary. So with all this in mind, our portfolio gives us a lower yield towards than the ag, but higher duration than the ag. Now that we have gone over our domestic equity strategy and our fixed income, what's left? Well, it's emerging markets, and I will let Richard take over for that.
Thank you, Isaac. Now, we did choose to allocate 5% into India. One of the concerns with emerging markets that we had was its corporate governance, which is why we chose to go with an actively managed fund, as we could defer to their tenureship. We chose the Matthews India Fund as they have a proven track record of outperforming the MSCI benchmark. Additionally, we saw they were more heavily weighted against that benchmark in financials, information and technology, and consumer discretionary, which are the growing sectors in India. And now I'm going to pass it on to Yusuf.
So we've just given you guys a lot of metrics, data, and trends, and we want to give you a more simple summary of what our process was. So first we began with our economic analysis. We really liked the United States, and we really liked India. From there, we went to our optimizer, which gave us a starting point, and from there, we did our tactical adjustments, where we increased domestic and decreased international, only remaining in India. From there, we looked at our sector allocations and looked at our economic outlook and to make sure it supported it. We see that there's been a structural shift in the economy that's favoring technology and innovation, so we decided to overweight tech. From there, we also saw that consumers have spent very much in this post-COVID economy, up to $2.5 trillion in savings from the pandemic. We believe that this is going to put risk to the consumers, and they're going to cut spending because of this, therefore leading us to underweight consumer discretionary. From there, we wanted to go with a growth strategy, but we wanted to make sure we're not overpaying for the stocks. We're looking at a growth at reasonable price strategy that looks at undervalued companies. And now that sums up our domestic equities, and now we'd like to talk about our fixed income. So we added our duration, and we wanted to capture the short-term yields. And from there, that was our total portfolio, which is going to be offering us similar returns to the benchmark, however at a slightly risk-adjusted ratio. We understand this is below the CFA spending goal, and we are willing to reach that goal if you guys ask us to do so. We can do this by going to more risky strategy, by going more into domestic equities rather than fixed income, or going with a more aggressive fixed income strategy that captures more yield rather than focusing on high duration. And now, I would like to bring up Richard to discuss why BAM.
Thank you, Yusuf. At the end of the day, we know it's about people. So why choose BAM? We have strong history with the CFA managing their funds for multiple years. We are a firm that is committed to continuous learning and implementing those learnings. One of the things we've learned this year was that we wanted to have a greater exposure to growth. We're still going to manage risk. We're still going to diversify. We still believe that is the prudent and right thing to do if you're looking for long-term risk-adjusted returns. We believe our strategy and our proposal is the correct approach for this environment. We believe it is supported by extensive research and economics. We are a disciplined team, and we will never make a decision without it being grounded in fundamental research. So I don't know what else to tell you except that when you hire us, we will do whatever it takes to meet our commitments to you. And that's why we believe BAM is the firm for you. Thank you all for your time.
Great job, guys. I really appreciated the reminders throughout the process where we were, how you guys are thinking about the multi-stage step to to construct the portfolio. So very clear and concise in that regard, so appreciate that. My question for you is in regard, well, it's a two-pronged question that may be kind of a similar response. So as you think about your capital market assumptions, so if you guys maybe want to pull up that slide, and then you think about the decision from an asset allocation lens to take 65% of the portfolio into equities. So knowing that the bands for equities can be anywhere from 60% to 80%, I would say you're at the lower end. So as you look at the capital market return assumptions, which I think you have domestic equities in excess of 10%, kind of surprising. That seems like historically that's a pretty attractive return for domestic equity. So it seems like you would then expect a portfolio to have at least 70%, if not 75 or 80% equity. So would love to answer or hear your guys' response to that. And part of that as well is on the capital market assumption slide, the return assumption for developed market equities was also quite attractive at over 9%. So to eliminate that from the portfolio, when the return assumptions are pretty attractive, would love to hear your thoughts.
Yes, I would like to take the deal on that one. Thank you, Casey, for it. So it all comes down to our economic analysis. Yes, CAPM serves as a great guideline. We just feel that it didn't reflect the current economic outlook, especially for international markets. We see more risk there, as I stated in the other slides. And then also, the fixed income we see as attractive due to the second half, we're projecting the second half 2024 cuts. So if you add in duration with the yield, you are going to experience equity-like returns. For example, when you go to the fixed income right here, so right here with the duration of 7.61%, let's say Fed's cut modest rates by 50 basis points, you're going to have around 3% bond increase price. If you combine that with 5%, roughly over 9%, you're experiencing equity-like returns for a fraction of the risk. So we did deem that as a more optimal asset allocation, and also we see risk in the international markets.
Is there anything, maybe as a quick follow-up,
just not an idea about drop. Is there anything that would happen in the next 6 months that would cause you guys to increase 65% equity to 70, 75%? Is there any kind of trigger, target, or metric that you're looking at?
That would cause us to increase our equity holdings?
Yes, from the 65%.
No, we're a firm founded on our research and data analysis, and it shows us that this is a more accurate reflection of our current analysis when we project for the future. And we wouldn't make any shifts, as this is what we believe we are projecting for the economy in the forward-looking years. So that is our reasoning behind that.
Good presentation. I have two fixed income questions for you. So first one, I want to know, can you elaborate a little bit, how, given the inverted yield curve we have, and how will you achieve capture yield and add duration? The second question is, if the scenario next year, if the rates hold a little higher or longer than you expected, or maybe drop quicker than you expected, how your proposed performance, fixed income portfolio will react? Thank you.
Yes, so thank you. I would first like to answer that question by saying that, yes, due to the inverted yield curve, that is why you're seeing that yield, even though we have higher duration, lower yield is worse. However, if it were to de-invert, that's where we would see those capital appreciation happen from adding duration. And then also, if rates did remain higher, the good thing is that we're invested in credit quality and also in the 50% into the ag, so we wouldn't really, it'd be really hard for us to really underperform the benchmark. However, we are rendering duration attractive right now, given that we're expecting modest cuts in the second half of 2024.
Good afternoon, everybody. We are Biola. As you guys probably know, it's our first year, so we just want to say thank you for letting us come aboard and compete. We're really excited to learn from you guys, and we're honored to be here at PIMCO. So with that being said, let's begin our presentation.
Thank you so much, Chris. There you go. So here's our agenda, just normal as usual, organization to 5-star recommendation. We're going to cover all of those points. First, our organization and people. We're a boutique shop, as you guys can see. 2 portfolio managers, 1 faculty, our Dr. Annette. We love it, Dr. Annette. And for investment analysts, we unfortunately only 2 of us could show up here, but we're so happy and we feel so privileged to be here. So this is our little history of Biola Student Managed Investment Fund. We don't have past performance through CFA, but we do have a performance of Smif's portfolio. We manage around $50,000. We started in late 2021. And our portfolio has outperformed the S&P 500 by 4% since its inception. And our individual stock that our analyst has chosen has outperformed the S&P 500 by 20% since its inception. And we're looking to secure about 0.5 to 1% allocation from our endowment fund, which should increase it up to $1 million. And we got some exciting news, guys. Biola is planning to incorporate the CFA body of knowledge into its finance concentration by the beginning of 2024 and 2025 year. And why us? Well, as you can see, we are a very, very small team. We have a very effective communication, therefore. Our asset allocation, as you will see, is pretty consistent with our economic outlook and our investment philosophy. And Dr. Inez is, in terms of our continuity, Dr. Inez is considering to incorporate the Smif and CFA OC competition both fall and spring to be a part of his curriculum. And that part is wrong. Not the next school year, but from next semester. So we are very, very excited for that. And this is our kind of investment philosophy and our market conviction. Thank you. There are 5 bullet points. 1, we believe the United States economy has successfully undergone a soft landing and is not expected to experience a severe recession. Moving down, these are some of our market convictions. First, U.S. large cap is overvalued. Third, U.S. mid and small caps are undervalued. And 4th, international investments are beneficial for diversification. And lastly, but not least, passive management is superior for the long term. And now Chris is going to take over our economic outlook.
Thank you, Hakim. Yes, segueing right into our economic outlook, we are going to be basing a couple components, if you want to change the slide for me, on our belief that the U.S. economy has successfully pulled off a soft landing and that we will not be experiencing a severe recession in the near future. So let's begin. First off, I want to say right now, when we consider a couple core metrics, it appears that we're in a much better position right now compared to past recessions, which gives us confidence into believing that we have pulled off this soft landing. If you would go to the next slide, please. Starting with monetary policy, as you guys know, interest rates are really high right now, dancing on 5.25% to 5.5%. It's getting more expensive for consumers like ourselves to borrow money and make larger purchases. As well, looking at a survey done on FOMC participants, a lot of them are expecting the interest rates to remain the same for the following year. However, they do have expectations with interest rates beginning to lower around 2025. Right, so we are trying to tackle inflation. That's why interest rates are so high at the moment, as you guys clearly know. And we're doing a good job doing it, but we are still facing 3.2% inflation, which consumers are still having to deal with today. So now that we've discussed what's going on, how is the economy responding to these kinds of factors? So looking at consumer spending, it is one of the biggest drivers in our economy right now. If you could go to the next slide, please. In 2023, both disposable personal income and personal consumption expenditures have experienced positive growth. Furthermore, household debt. We are experiencing historic lows in the amount of household debt that is being spent on disposable income. Less disposable income has been spent, literally less on household debt from consumers, with more disposable income left over. Therefore, it is encouraging consumer spending in other areas. As a result, this is becoming a driving component to our United States GDP. In the third quarter alone of this year, the United States economy experienced almost 5% growth in GDP as a direct result from increased consumer spending as well as other factors. So talking about labor markets, as a result, to match this high GDP, we need to have an appropriate amount of employment going on right now. As you can see, we have a little under 4%, so we're looking really good. Furthermore, let's talk about the housing market. So this is a little more interesting subject in terms of our economic outlook. We believe we've pulled the soft landing, but the housing market is a little shaky. When we talk about interest rates, they are currently affecting mortgage rates. As you guys know, they are reaching historic highs, dancing around 7–8%, and most consumers can't afford to borrow that much money to make larger purchases. As a result, fewer people are beginning to apply less for mortgage loans, so fewer people are buying homes. But if you look at the next slide, we're experiencing something very strange that analysts are calling the golden handcuff scenario, where people who are already existing homeowners they have locked in lower rates, and because they have that lower rate, they don't want to let go of that low rate by selling their home. So we're not, it's like an in-between right now. We're not sure if it's a buyer's market or it's a seller's market, but we have to look at the silver lining, which we'll talk after this, but I have to make this point. Vast majority of homeowners have 30-year fixed mortgage rates. About 70% of the homeowner market share currently have 30-year fixed mortgage rates, which goes into our silver lining that even though we're in a weird position right now in the housing market, we have confidence that we are not in a similar position like we were in 2008 to experience another housing market crash, because a majority of people have fixed mortgage rates. So they won't be influenced by these fluctuating high interest rates. And now let's get into the asset allocation.
Thank you, Chris. As he has covered more of a positive economic outlook, so how should we allocate our portfolio? We're going to allocate 80-20 portfolio, and we'll talk about our condition later. 80% equity, 15% large cap, 25% mid cap, 20 small cap. So a little bit overweight on mid cap, and 20% international. And other 20% is going to be a little bit more hedge against equity portion. So 10% treasury and 5% for investment grade and 5% for cash. So let's just go back to our drawing board and let's look at this. So we talked about how U.S. economy has successfully undergone a soft landing, and now I'm going to click the 4 bullet points there below. So our equity valuation and selection. So we believe that U.S. large caps are overvalued. We look at there as of October 5th, 2023, S&P 500 has returned 12.4%, pretty significant, yeah. But when we look at their equal weight index, you see that they have only returned by 0.1%. And we believe that that's because of this M7, as you guys call it, Magnificent 7. Top 7 companies account for about 30% of the weight of the index, pretty significant. And we also believe that S&P 500 valuation is historically expensive. There's a lot of numbers there, but what we really want to focus is the 4th column, percentage above or below average. And as you can see there, equity valuation, the percentage, they're all above the historical valuation method. But in contrast, so we talked about how the large caps are overvalued, but now in contrast, we believe that Smith caps are undervalued. So first, let's look at the small cap valuation. Again, the average and the current PE ratio and some other valuation metrics. And as you can see, most of them are very negative. And we also believe that mid caps are much cheaper than mega cap. If you go above the line average there, that means that mid cap have performed better than mega cap. And when it goes below, that means they're not performing better, much expensive based on the PE ratio. But when it goes below the average line, that means they're much cheaper than a mega cap, and we're seeing that right now. And how about for international investments? We briefly talked about U.S. equity. About for international investment, well, we believe that international investments are pretty still beneficial for diversification purpose. There's a very long historical number there. We have, I think, have grown into a little bit more of recency bias towards U.S. equity, and we're seeing, ever since I was born and I've followed the stock market, U.S. was the best. But we believe that when you look at the long-term record, I think international equity could come back. This is an interesting chart. But what I want you to really focus on, the current PE ratio on the top right compares to 20-year average PE ratio. So S&P 500 again is above that, whereas the world is below the historical average. And this is a very interesting chart that I found. S&P 500 index, their EBITDA margin is declining, but we see that from 2021, the international market, especially the developed market, has been increasing their EBITDA margin. as we've covered the equity portion, this is kind of talking about our conviction in terms of our method. We believe that passive management is superior for the long term. Sorry, there's a lot of number again, but what I really want you to focus is a 10-year benchmark there. When we look at there, most funds, if not all funds, 90% of active managers are underperforming. And maybe can't be saying this because we're, at PIMCO and CFA OC competition, but historically that has been the case. And passive management is also superior for the long term for the cost effectiveness. When you look at our expense ratios and our average weighted is 0.045%, and you won't be able to find that for an active manager. Now let's look at our fixed income valuation. So we believe that 80% equity risk, that's decent amount of overweight, and we're aggressive portfolio. So we're kind of hedging our big space equity risk there with a little bit more conservative approach on our fixed income strategy. So 10% on treasury, 5% cash, and 5% on investment grade. And now I'm going to pass it on to Chris for security recommendations.
Thank you, Hakim. Yes, security recommendations. So looking at this housing market, we believe that we have found an opportunity to find a stock that is undervalued with this strange situation that we're in. And Solar Edge Technologies fits this scenario for us, powering people's lives one day at a time. Yep, so some key drivers about Solar Edge. We have found a historic effective growth strategy that we'll talk about later, as well as a consistent growing revenue, as well as long-term positioning with legislation support. So who is Solar Edge? So basically it's a solar industry company, and they sell solar installers to thousands of large distributors, solar wholesalers, and installers. They are present in 36 different countries and sell to 133 countries worldwide, and they have one goal in mind right now. That's to increase market share by penetrating emerging markets. So some stateable competitive advantages include that they have unique patented technology. They have found a way to create microinverters cheaper while maintaining that high quality so that they can compete with larger companies. For those who don't know what a microinverter is, solar panels collect the energy, the microinverter takes it, and that's what converts it into the energy you use in your home. As well as they take pride in their high reliability and affordability for their customers as well. And like I said, they have early position, early markets, which we'll talk about right now. So their growth strategy is, I guess you say it's bound with their manufacturing strategy, and it's threefold. So they outsource, automate, and localize. So they strategically try to build overseas relationships with manufacturers that are located in target markets that they want to sell to, like Asia, Europe, and Mexico. And there are a couple benefits to this. They obviously have they pay outsourced labor, so it's cheaper production. And as well, because they're closer to their customers, they cut their delivering times by a significant margin compared to their competitors. So we used to have a graph here, didn't work out. I'll give you the numbers. So like I said, they want to expand their market share overseas. The graph, so basically, if you look at like in 2018, the majority of their profit was actually coming from the United States. It was around like 55%, but the graph is supposed to show that compared to now, over 50% of the revenue actually comes from Europe. And what that tells us is that is a successful implemented growth strategy that we believe will continue to succeed in a normalized market. Right, so talking about some of the valuations that we did. So the solar industry is very fragmented. It only has 2 large cap companies. So I just compared Solar Edge with the other mid cap companies, and it came out with an industry average of 24, intrinsic value of $91. As well, the normalized valuation. I want you guys to look at their growth rate with their revenue. Excluding 2020's revenue growth rate, they have an average of 49% in growth revenue, which is very impressive. You guys might be questioning, okay, Chris, that's all great, but what about their profit margin? It's not about how much you make, it's about how much you keep. Specifically, I'm talking about 2022. 3% profit margin isn't the most attractive, and while they do have a lot of benefits with relying on overseas manufacturing, there is a trade-off in that they are susceptible to supply chain disruptions, which in that case was caused from post-pandemic, sort of a domino effect from COVID-19 that had happened. But we believe that in a normalized market, when supply chains are healthy, they can continue to prosper and grow their revenue over time. This normalized valuation model, we came up with an intrinsic value of $132, and when we averaged both intrinsic values, we came up with an intrinsic value average of $112. It's currently being traded at $76 a share, creating 48% margin of safety. Thank you guys for your time. We're looking forward to your Q&A.
thank you guys. First and foremost, really appreciate all the effort. I know you guys are working with a lean team. It's your first year participating in this program. I really appreciated the onset sharing some of the background about the program's prior experience in managing some other funds as well. I think that just shows that you guys aren't showing up out of nowhere. So kudos to you for taking on this year's challenge and showing up and showing really well. So nice job on that. I'll comment on the 80-20, especially given the fact that a lot of people in the room here are either 60-40 or 70-30. I appreciated that in an 80-20 asset allocation, you took the 20% and made it more of a ballast or a hedge versus putting that 20% into higher yielding, more credit, equity sensitive type fixed income. So appreciated that thought process. Would love to know your thoughts on why lower fees are necessarily better when we're looking at, active versus passive mutual fund ETF, et cetera.
Yeah. Thank you for the comment and great question. I should have actually included this on our slides, but we also believe that active management is better during the recessionary time. And the passive management is harder to choose winner than to delete out the losers. And as a result of that, I think passive management, even in this case, we might change it later on. We're not too sure yet, but I think passive management also aligns with our investment philosophy and economic outlook.
Given that you are so focused on passive management, could you demystify your equity allocation a little bit for us? I mean, I see the numbers up here in terms of the big picture allocations, but when you think about that 80%, what's the split between low-cost ETFs versus common stocks that you guys have selected? That would be helpful elaboration.
Yeah, sorry, we should have. No, sir. We quickly show you there for the weird presentations there. But our expense ratio, that's all the stocks that we have currently. So they're all ETFs,
okay.
Very, very low cost. And yeah, that's the weighted average at the end as well.
Thank you.
First, I like your energy and passion. I think it's good to just for two people to put up all this work. So I want to know for the fixed income portfolio, when you invest in those ETFs, what are the yields and duration they have, and how would you expect those to hedge equity risks?
Yeah, so yields, and again, sorry for not including those numbers. For sure, for duration for government, it's I think it's 5.8 or 5.7 gov. This iShare ETF, and then for the corporate bond, it's actually a year longer, so 6.7. So it's pretty. We're just right about the average industry average. And the reason why we chose that is because we're a little bit uncertain about what's going to happen in the future, and just through that, we just decided to go a little bit passive on those.
So do you feel like those positions will perform, like it's not correlated to the equity performance in the future scenarios you're thinking about?
Just top of my head, I don't really think so. I mean, cash, you're not going to get anything from there. Investment grade, you can see a little bit of correlation as well. But then for the government part, I mean, if the equities are starting to perform better, I mean, the government, people are buying government right now because of the yield and what they can get from that. And if the equity starts to perform better, I think government's going to come down a little bit.
Yeah, I agree. I like your energy too. I think you guys are great. And I think it was a great recovery when, just like the Long Beach had the remote control not working, when you had the truck missing, it was a nice recovery and it did flow you off, and I think you did well with that. I like, and I generally agree with what you're saying about large cap being overvalued and small cap and international being undervalued, and those data what you had about cheapness. As a long time holder of international, it being cheap for a long time and underperforming for a long time, is there any other factors you would look at to determine making or other situations you look at in deciding whether or not to change?
For international, I mean, Yeah, we could be looking at some of the factors such as, like how, the strength of the US dollar, or how are they doing economically. We have covering, China, US, and India, and all such categories. And our conclusion was that it wasn't too sure in terms of how the international overall is gonna do. There's one no like big significant factor that would outweigh anything else that is indicating one way or the other. So we just said, hey, I think it's going to be pretty good to be still diversified and not miss out on those international growth if it does happen. Because it's so cheap, as we see. Yeah.
Thank you. Great job. One question on your position in U.S. or in equity generally. You have a pretty significant overweight to small and mid cap.
Yep.
Appreciate some of the points you've made about valuation. What do you think needs to happen to have that change? And I guess just, that's a fairly risky position, I think. And there's also an argument out there that those companies are more susceptible to higher interest rates and just generally may face more headwinds from a growth perspective. So I guess just how are you thinking about that with those specific companies?
Yeah, first up in terms of the valuation method, when we think about, okay, when to buy certain things, we really want to buy cheap. I mean, I've seen a lot of past historical numbers showing up over and over, and hey, that's why, because this number is going up, therefore we're going to buy it because it's going great. Well, no, we want to buy low and sell high. And I think that market has taken into account of that result, of exactly what you're talking about, of the interest rate. And as you guys seen in the past month, the stocks, Smif caps are rallying up. And I think it's because, hey, maybe they're still doing pretty well despite the interest rates going up. And we don't want to be a follower in that. We just want to buy when it's low. And I think market has already counted in, and that we're only going to see, hopefully we'll see a rally up, but yeah. But we just want to be consistent with our economic outlook as well.
I maybe have another question. So in regards to the individual stock pitch on a solar company, and noting that a lot of the expectations for that stock's growth are in emerging countries, as someone who's individually thought about solar and then did not do it because of the cost, I would imagine there has to be some kind of government subsidy program that's happening in emerging markets in order to see that increased demand from consumer businesses there. So did you guys look into whether any of those programs exist for this company in particular?
So I don't have an answer to that, but doing my own research. Thank you for asking me a question, by the way. Like, I'm not using all that. No, but when Solar Edge is pursuing overseas manufacturing relationships, they try to target areas where costs are a lot lower to implement electricity and things like that. So in terms of government subsidies, I have no knowledge about that. But they are trying to approach that in a costly way.
Yeah, I would also say I don't know the answer either, but if we can buy direct, that would be great.
Yeah.
Any other questions?
Yeah, I have a quick question. So you spent some time talking about the mortgage rates and the housing market. I think those, I do agree, but how would you incorporate that into those information into your investment process?
Great questions. And then the reason why we mentioned housing market is, I think we see it as a neutral. That's why kind of Chris has talked about it. It's a golden handcuff situation where there's not a whole lot of buyers and sellers going on, not many transactions. Therefore, housing market is not doing like too great. But on the flip side, we're not going to experience a recession due to housing market as we did in 2008. So we put it as kind of a neutral stance on that, but then still the strength of the economy driven by consumer spending in a very strong labor market has led us into our asset allocation.
Thank you. I thought that's a question for you, but actually.
I apologize. Yeah.
Okay, thank you.
All right, that's all. Thank you guys. Great job.
All right, hello everyone. Before we start with the presentation,
presentation. Just wanted to take a moment to thank you all for allowing us to compete in this competition. It's been a while since we've been here in 2019. We're enthusiastic about presenting our findings here today. We spent a lot of time modeling and researching every aspect of this presentation. So to start off, we'll first talk about our portfolio management overview. Our PMs are going to be here today to talk about our corporate or organizational structure and process. Since we haven't been here since 2019, we want to go over how we plan to attract and maintain high caliber members who can make quality investment decisions. Then we'll go into our macroeconomic analysis. That concludes with our asset allocation before going into each asset class more in depth. Now I'll hand it off to Leland and Marcos to go more in depth.
Thank you, Christian. Now going into our portfolio management overview. First, we're going to touch on structure, then portfolio performance and asset allocation, our market performance and portfolio metrics. Finally, more into asset allocation. We'll talk about proposed asset allocation and how that reflects based on our team's research. Now, I want to highlight our team structure so that we can drive in the different changes we've made with our RFP team to ensure two things: continuity and stability. First and foremost, our RFP team, the Anteater Investment Management team, has integrated itself with a finance club on Irvine's campus called the Irvine Investment Trading Group, ITG. ITG seeks to develop Irvine students and help them land offers at financial firms, as well as encouraging them to participate in other financial organizations on campus, such as Anteater Investment Management team. ITG is responsible for two things relative to AIM recruiting and AIM marketing. Not only do we recruit from ITG's feeder development program, we also recruit from top candidates in other finance organizations on Irvine's campus. All of this, of course, is overseen by our CFA advisor, Professor Todridge. Now handing it over to Marcos.
As for the Anteater Investment Management or Smif team, it's overseen by the portfolio manager, alongside compliance officer and performance management and risk analysis team that's
All right, hello everyone. Before we start with the presentation, I just want to take a moment to thank you all for allowing us to compete in this competition. It's been a while since we've been here in 2019. We're enthusiastic about presenting our findings here today. We spent a lot of time modeling and researching every aspect of this presentation. So to start off, we'll first talk about our portfolio management overview. Our PMs are going to be here today to talk about our corporate or organizational structure and process. Since we haven't been here since 2019, we want to go over how we plan to attract and maintain high caliber members who can make quality investment decisions. Then we'll go into our macroeconomic analysis. That concludes with our asset allocation before going into each asset class more in depth. Now I'll hand it off to Leland and Marcos to go more in depth.
Thank you, Christian. Now going into our portfolio management overview. First, we're going to touch on structure, then portfolio performance and asset allocation, our market performance and portfolio metrics. Finally, more into asset allocation. We'll talk about proposed asset allocation and how that reflects based on our team's research. Now, I want to highlight our team structure so that we can drive in the different changes we've made with our RFP team to ensure two things: continuity and stability. First and foremost, our RFP team, the Anteater Investment Management team, has integrated itself with a finance club on Irvine's campus called the Irvine Investment Trading Group, ITG. ITG seeks to develop Irvine students and help them land offers at financial firms, as well as encouraging them to participate in other financial organizations on campus, such as Anteater Investment Management team. ITG is responsible for two things relative to AIM recruiting and AIM marketing. Not only do we recruit from ITG's feeder development program, we also recruit from top candidates in other finance organizations on Irvine's campus. All of this, of course, is overseen by our CFA advisor, Professor Todridge. Now handing it over to Marcos.
As for the Anteater Investment Management or Smif team, it's overseen by the portfolio manager, alongside compliance officer and performance management and risk analysis team that's major indicators, and within those asset classes, they're divided into, for example, fixed income, bond segment analysts to ensure exposure to all bond segments, as well as domestic and international analysts to look at industry stocks, industry rotation, as well as country rotation.
Our process is consistent and committed to adhering to our investment philosophy and our top-down asset evaluation. starting with our first step of the process, serving the client, meeting the CFAOC's objectives.
Second is our philosophy and approach. We employ a top-down approach, making sure that you're looking at value-oriented companies as well as protecting downside, having downside protection.
Most key to our process is our strategy. First and foremost, the bread and butter of our strategy, enhanced indexation in each sector. We look at country and sector rotation as well. Of course, always maintain that we manage risk volatility, understand our correlation, and always analyze our tracking error between our funds.
As for our weights, through our portfolio optimization and macroecon outlook that the macro team will be presenting to you shortly, we decided to go to 60-40 equities to fixed income with 92% and 8% domestic and international equities perspective.
Finally, touching on our goals, of course, to meet the client objectives and also comply with the investment philosophy statement requirements. More on the IPS.
The committee aims to maintain the 6% spending on administration and scholarships, and also the real value of the 94% remaining portion of the portfolio. From web catalogs, I was able to find that the average tuition interest rate across the 6 universities that the committee sponsors scholarships to were averaged 3.26% per year. To achieve that, the required nominal rate, either we assess that from the tuition interest rate or the CPI in the past 5 years, would be around 10%. And the real return rate per year would be above 6%. That's because our maintained portion of the portfolio is not 100%, but instead is 94%. Thanks.
Thank you, Jerry. Touching on risk and performance management now. Our first area of risk management, we track key metrics within our portfolio, think alpha, beta, Sharpe ratio, information ratio.
Second is our tracking vehicles. We use Bloomberg's advanced monitoring capabilities, as well as FinViz, as well as research associates look at historical data, optimization, as well as portfolio backtest.
And finally, resources we use to conduct research, Bloomberg, Capital IQ, both provided through the UC system. We also rely on InvestTech for further information on companies and markets. Now I'll hand it off to our macroeconomic analysis team.
So, to start off, obviously no one knows what's going to happen in the markets tomorrow, let alone weeks, months in the future. What we can do is identify significant trends that can impair our results or our returns if we do not allocate accordingly. We'll analyze the following 3 trends that we think are going to have the biggest impact on future returns. First, strict monetary policy, weakening consumer and business, and increasing geopolitical tensions. All of these lead us to have a cautious outlook for 2024. For central bank, obviously after the pandemic, rates dropped to near zero, inflation quickly ensued, rates increased along with inflation, now at 5.25% to 5.5%. However, we believe the Fed is not done. Even though inflation has cooled down, core CPI came out in October at 4%, still double the target inflation of 2%. Core PCE is still at 3.7% as well. Now for the consumer, after the pandemic, stimulus checks accustomed consumers to unsustainable levels of spending. This has been diminishing their savings, and on top of that, credit card debt has hit a record number of over $1 trillion, 4.7% quarterly increase, and student loan repayments on top of that have caused increased financial burdens for the consumer. Worse yet, consumer sentiment has on 3 straight months of decline, and unemployment has ticked up to its highest levels in January 2022, which we expect to continue to increase. Now I'll hand it off to Aya to finish it off.
So for our business outlook, it's overall pessimistic. We've seen that the OECD's business confidence has been on a decline since its peak in 2021. Corporate profit is still relatively high, but we expect profits to decline as, again, consumers are spending less, as we just talked about that. So for the manufacturing and services sector, thank you. Both of them are signaling a relative slowdown in the economy. The manufacturing PMI is contracting and it hit below 50, and new orders have also been declining for the past 4 months. As for the service sector, it is still above 50, but it's growing at a slower rate, and it actually hit a 5-month low. Moving on to geopolitical, we know that the U.S. is entangled in some geopolitical challenges. It's involved in a proxy war with Russia and the Israel and Gaza conflict. There's also an ongoing trade war with China, pushing the U.S. to look a little bit more inward for GDP growth. So obviously these challenges are going to have economic impacts. As we've seen, there are concerns about the Russian Middle Eastern potentially spiking oil prices, and we could see them exceed $120 per barrel in the next few months. This is not just impacting the global economy, but also the domestic fiscal landscape. We've seen federal expenditures go up steadily, and they're projected to reach 36% of GDP by the end of 2023. We also know that the U.S. is heavily investing in clean energy, which is very good. So this, combined with decreasing government deficits, leads to a negative outlook on U.S. credit rating and also increased skepticism from treasury investors. So to summarize the macroeconomic outlook, we talked about our 3 main indicators. We have the strict monetary policy. We know that the Fed is still pursuing that 2% goal, so interest rates might be higher for longer. We talked about the weakened consumer and business confidence are slowing down and pointing to a slower economy in the next year. And finally, for geopolitical tensions, they're on the rise and contributing to economic uncertainty, inflationary risk, and investor skepticism. But obviously, we don't just look at macroecon in a nutshell, vacuum. We also look at the implications on our portfolio. So we are in line with consensus forecast for GDP and interest rates as we foresee in 2024, GDP growth being under 2% and interest rates hovering around 5%. So this is obviously going to have implications on our equity and our fixed income, and I'll let the equities and fixed income teams go over that. But finally, that brings me to our proposed allocation. As we've seen, we are very overweight on fixed income with 40%. We are slightly overweight on domestic with 5% and 15% underweight on international. And I'll pass it on now to the fixed income team.
Thank you, Anna. So for fixed income, our strategy is to focus on treasuries and investment grade bonds, aiming at 2 to 3 years duration, and we prepare to extend our duration when there are signs for dropping interest rate. Our goal is to outperform the benchmark. Looking at our fixed income portfolio, we are overweighting U.S. treasuries and investment grade, and performing no allocation on high yield mortgage-backed securities and emerging market. Looking at the bond market in general, we currently have a higher inflation than the Fed target, and we predict the interest rate to stay high for the first 6 months of 2024. And looking at the treasury yield curve, we currently have the inverted yield curve, which is a sign for upcoming recession, and also it's the reason why we are going for low duration portfolio. Here is our technical allocation along with sensitivity analysis table versus the benchmark. We are overweighting treasuries by 20% and overweighting investment grade by 11%. Our final portfolio has 3 years less duration compared to the benchmark. It helped us lock in the maximized yield, and according to our sensitive analysis, it helped our portfolio to be less sensitive to rate changes. So we are overweighting treasuries, aiming at short to mid duration, and we are also allocating 10% of long-term treasury to give us capital appreciation. Our team will closely monitor signs for interest rate drop and stay prepared to transition our duration, portfolio duration to a longer term for maximized return.
Moving on to the credit segments for bonds. Starting with investment grade, we're overweight compared to the benchmark, still aiming for that short duration, looking to get those stable returns in the expected economic slowdown. The spreads are very important in this segment as well as the other ones following, and we hope to be in the investment grade with the treasuries if they do widen. And we're just focusing on those high quality, non-cyclical firms, similar to our equities research, so that we can have the highest yields in a more stable environment. At high yield, we're staying in no allocation. The default risks are extremely high. There's more CCC rated companies every single day, and we like to stay away from that. Mortgage-backed securities, we're underweight due to the high mortgage rates at this current moment and the lower spread in the past 8 weeks, as well as mortgage-backed security premiums have been slowing, and lowering our premium at the same time. Emerging markets were underweight just due to the overall performance China and the other wars, as we spoke about in our macroeconomic section. So high cost of debt, and there's unnecessary risk in the emerging market sector. So summarize it all, we're very cautious, and in the moment we are monetizing our cash flows with that lower mid-tier duration. We hope to increase our cash balance, and then when we're ready and see it in the economy, we're going to go into that longer duration, or if it's a more positive economic outlook, we'll go into equities. We're just trying to raise that cash balance with the higher yields in the short term currently. Now we'll pass it off to our domestic equities to speak on that.
Thank you, Brendan. For our domestic equities, we'll be covering our 2024 forward market valuation, our portfolio sector allocation, as well as our equity recommendation. Scenarios like high corporate profit, cool inflation, and funds going back to the equity could contribute to a bull case. However, we see that Russell 3000's PE ratio is at a relative high position, disregarding the extremity of COVID. So, meaning that the equity market is expensive, we're aware of that, so we are using a defensive strategy. And our current economic condition of weakening consumer sentiment and personal savings and so on, we think that there is a bear case scenario that might be happening. You can also see on the EPS graph that there is a plateau, and analysts have been downward revisioned 3 times in the past 2 months. So supporting our view that there is a potential recession hitting in the next 6 months. Based on our calculations and projections, we arrived at a target price of $2,627 and a total return of 5.5%. This is considered moderate compared to historical trends, and I'll pass it on to Brendan to talk about how we incorporate that in our strategy.
Thank you, Teresa. Our equity allocation focus is heavily leaning towards our domestic equities, and our international team is currently still in development. Just as a reminder, we have sector analysts managing our portfolio, but our international team is contingent upon the improvement of market conditions. Our domestic sector allocation strategy is it's low volatility, non-cyclability, and high dividend yield stability contingent for a recession defensive stance. As seen with our conservative beta and dividend yield, they take very recession defensive stances as seen. Now, the energy sector is characterized by earnings growth and yields, and primarily through the rebounding demand that is driving consumption and geopolitical tensions, as previously mentioned by my colleagues who are involved with the macro section. The valuation shows 2 metrics which are heavily supportive of our recession defensive stance, primarily our dividend yield standing at 3.13%.
Now touching more onto our other overweight sector, consumer staples. We overweight this based on our macro team's portrait of the weakened consumer. Aside from that, there are still pros providing tailwinds for this sector. Retailers are cutting costs and trying to increase perceived value for consumers. There's a decrease in operating margins due to lower energy costs recently, as well as a survey by McKinsey shows that 66% of consumers are opting to trade down more cost-effective options in consumer staple products in stores. Cons, however, there are lower earnings and tighter margins pressed on consumer staple retailers due to emerging market production. As well, there's a possibility that fiscal policy could curb recession, and this could slow defensive sector returns. However, looking at our current forward PE and attractive dividend yield, our final analysis is that with the weakened consumer factoring possible recession and positive tailwinds indicating the sector will outperform in the coming year. Now, touching on our international equities overview. 8% of our equities are allocated towards international, and this is because we believe domestic and international equity performance is cyclical. We now see international equities cycling back on top. We will identify key drivers as we build out our international equity team to find companies that we're confident in emerging developing markets. But for now, we're allocating 8% of our international equity towards the MSCI All World Country Index. We choose this because its current dividend yield is attractive, and we're planning to reallocate international equities, so we're not as worried about the PE going forward compared to other world indexes. Now, onto our individual equity stock pick.
So, our individual stock pick today is CrowdStrike. CrowdStrike is a cybersecurity platform with one product, its Falcon platform. It's a multi-tenant, single-agent, AI-enabled platform that has seen impressive growth over the past couple of years. One thing we look for is industry growth. If you ask any investor, what they look for is a market at upper single-digit percentage growth CAGR over time. We see that cybersecurity industry is growing at 13.6% until 2030. On top of that, damages from cybersecurity attacks are growing exponentially year over year, and we think this is a sticky product with high net retention of 120%, consistent ARR growth of around 37% for 2023, and great valuations that Leon will touch.
Touching on the quantitative side of our analysis of CrowdStrike, when we initially picked this stock around the 1st of November, its trading price was somewhere around $175. After doing a DCF and a two-stage growth model, because it is a rapidly growing company right now, with conservative growth assumptions, we found our target price to be $198. Recently, it has soared much higher above that, and that's why we recommend for now, CrowdStrike as a hold. But due to the factors Christian mentioned and our extreme confidence that this company will continue to perform, we will hold this company within our portfolio for the foreseeable future.
And with that, we'll open up to any questions. Thank you for giving us the time.
Somebody else wants to jump in at first line.
I think you asked me.
Just like a very low voice.
I get started with the first question. So I saw your fixed income portfolio. You allocate to some investment grade corporate bonds. I want to know, for the first one, I want to know like what kind of relative rating of those. And for the corporate bonds, because your economic outlook sounds relatively more pessimistic than other teams. And so if like default rates, you expect default rates will go up or the recession is coming, then even though there are no defaults for the IG investment grade, but their spread will be widened significantly, right? What's your thoughts on that?
Yeah, definitely. I mean, the spreads are going to widen, not as much to high yields, but to a significant amount. And we do believe in the pessimistic realm that if there's an economic slowdown, treasury rates will also decrease at the same time, offsetting that widening spread. So that's why we would want to stay in investment grade, even though we're more in treasury rates. And then, but most of it is all to get the cash balance so that we can move out of those sectors.
Well, first comment, welcome back. We missed you guys, so I think it's great. I don't want to say first showing, but it's been a couple of years, so it's really great to have you guys back. It seems like you guys kind of just jumped right back into it, like there's been no loss of time. So I think you guys did a really great job and really impressed. I think overall my comment is, it was very clear to me, given where you started your economic thesis and how you align the portfolio, as to where you stand and how you're going to allocate the portfolio accordingly. And I think that's really, really important. So kudos to that. My only question at this point is in regards to overweighting or favoring the energy sector being recession-proof or more defensive in a recession. That feels counterintuitive. So my understanding is that it's more of a dividend play. But energy stocks historically, not to say going forward, but historically have been a little bit more volatile in regards to their dividend payments, because you can kind of manipulate that through stock price and other exercises. So just any like high-level thoughts on energy being a defensive play in a recession?
So for energy being defensive, our thought process was if geopolitical tensions continue to cause inflationary pressures, especially on oil prices, through our enhanced indexation strategy, we'll allocate some weight to the major ETF, but also our analysts will look specifically at sub-industries that have positive relationship with oil prices that we can target to maximize.
So within your equity allocation, can you give us a sense for your process? As you think about the split between common stocks that your team hand selects versus using an ETF for purposes of either a sector or broad-based market exposure, and then can you give us a sense for what your equity allocation looks like? I mean, you gave us the percentage allocations from a high level, but again, from a common stock versus ETF perspective, what that composition looks like.
I would say for us, our main philosophy is the sort of less is more. So right now we're taking the approach, if we find valuable common stock opportunities, then we'll invest our time and resources to see if it's a valuable opportunity. For the most part, we believe that enhanced indexation is what's going to drive our risk-adjusted returns.
So sorry, just one question on that then. Given the stock pitch and knowing that it's a hold, which by the way, I appreciate you guys tracking that since you've made the recommendation and realizing that maybe the return has been realized. So starting January 1, when you guys send us, we implement your portfolio for January 1 of next year, will that stock be in the portfolio then?
So basically with our buy or sell process as outlined in the appendix of our RFP, we give a 10% cushion once it hits target price, and then we reevaluate at that point whether or not we made the right decision or are making the right decision. So should it hit that 10% cushion of our target price threshold, then we would either decide to continue to hold or sell. But we're going to have to see how the markets treat CrowdStrike. It's currently around 204 today, but it was 207 a couple of days ago, so it's fluctuating. It's relatively volatile right now, but we'll have to see in the future going forward. But we'll just follow our process for sell, or hold, or buy.
Yeah, I agree. Your forecast returns are, I think, the lowest we've heard so far, of like 5.5%. And it's something you guys are, investing like that. And you guys are talking about how you guys are so short right now on the fixed income side, short duration. What specific signs would you look for to extend duration? What specifically, what kind of factors or data, economic data points are you looking at that kind of inform that decision?
Our decisions, our forward-looking decision based on if we were to change our asset allocation would be depending on our forecasted rate cuts. If we believe our rate cuts are going to happen, maybe the latter half of 2024, we'll then transition our portfolio from shorter duration to longer duration, and then possibly even get into the equity side, as we believe that it might get hit a bit with the continued high rates, and especially with the funds flowing from the equity markets to the bond markets, we'll be doing the inverse relationship of course the rates were to get cut.
So, just based on what you just stated and what I heard in the presentation, just expanding on that, I think I heard the expectation already is the potential recession in the next 6 months. What other indicators do you need if your expectation, which is 6 months is not a long time frame? Shouldn't you already position for something like that if you're already expecting it within your kind of forecast?
Currently, we're taking it on a step-by-step basis, especially since with the rising geopolitical tensions, we don't know how the supply chain is going to act up. If all things remain equal, of course, then we'll start putting our fixed income securities into a longer term duration.
Now, I question the overweight to fixed income a bit and challenge that position a little bit, because when you look at your return expectations and you look at it from a real return basis, I believe it was close to 7%, 6.8, whatnot. How do you get to that target with such an aggressive allocation towards fixed income in an environment like this, when you're reducing the larger return driver of equities, right? And so is that feasible, and why would that be feasible if you do increase that allocation to fixed income? Because we're talking nominal returns versus real, right?
I think, and I'll touch a little bit more on the duration thing too. I think what we have in where it is, in obviously, we have 6 months, right, we're projecting before it gets a little bit more gray. And assuming, we don't really assume they're going to cut super fast. They're going to kind of stay a little bit longer. They might cut like 100 basis points or 50 basis points. We don't really expect them to go 300 basis points before we get a significant margin. If we're in that regard, we would stay in a 6-year duration. But that's why we're kind of staying in 2 to 3, not like a lower duration. If we do see data that provides that there is going to be a stronger economic slowdown, we're going to allocate very quickly to dropping down and increasing that duration. But in these next 6 months, with the higher yields, we feel like we're missing out on that opportunity to monetize those cash flows. And then when the rates do go down, we'll get the capital appreciation, and that's going to give us that extra percentages to hit that real rate.
I'll also say what the Fed's trying to do is not repeat what happened in like the 1970s, right? If there are any indicators of the market slowing down and they aggressively cut back rates, they don't want it to bite them back. So I think that's why it's kind of driving our enthusiasm that they're going to hold rates out for longer. So I think that kind of agrees with what Fixed Income is going to say.
Any other questions? Great.
Thank
Thanks,
you,
guys.
Thank you to everybody in attendance. I'm Dominic Spano, the co-president of CSU Fullerton Student Managed Investment Fund.
I'm Eric Rollins, co-president. I'm Jacob Pasica, assistant director of fixed income.
I'm Keyshawn Patel. I'm Will Hall. I'm Matt Kennedy.
My name is Kirsten Haskell.
I am Thomas Shermonti. I'm Jeff Sellis, and I'm Luke Newton.
We want to give a special thanks to the CFA Society Orange County for their continued support of our program, as well as to PIMCO for hosting us at their beautiful location. I'd like to get us started by briefly discussing our agenda for today. We're going to begin by discussing our people and culture. We'll move into our economic review and outlook, followed by our investment process, our stock pitch on Kenview, and then round it out with our historical performance.
Thanks, Dom. We'd like to begin with our people and culture, as we take great pride in developing the abilities of our members for careers in finance, as well as encouraging them to give back to our program. We are guided by 2 faculty members, Professor Kelly Coe and Shane Camp, 2 industry veterans who provide valuable insight into our portfolio construction, security selection, and operations. Our leadership team, comprised of 2 co-presidents and their supporting directors, help further our people-oriented mission of year-round management, peer-to-peer mentoring, and leadership development. This academic year specifically, we were blessed with an abundance of new Smif students, allowing us a unique opportunity to lay strong foundations that we believe will pay dividends in semesters to come.
Thank you, Jacob. Cal State Fullerton Smif takes great pride in cultivating relationships with alumni to promote mentorship opportunities and receiving feedback on how our program can improve. We'd like to highlight 2 of our alumni from last year's graduating class, Mr. Jericho Caesar and Ms. Jacqueline George, who credit our program to building the necessary skill sets to secure full-time positions after graduation. Furthermore, we'd like to highlight some of their achievements, which include winning the Institute Research Challenge America Finals and representing Cal State Fullerton at the Global Finals. We will now have Mr. Will Holland discuss our program's economic outlook.
Thank you, Keyshawn. So our economic house view is we expect turbulent macro environment with depressed corporate earnings and a weakening consumer, driven mainly by higher interest rates and entailing consequences. We believe that with this inflation, there are certain sectors that we could avoid, but we'll discuss more of that later. All right, starting off with inflation. Inflation has been very stubborn, around the 3 or 4% range, much higher than the Fed's stated 2% goal. We believe this is partially driven because of onshoring or nearshoring, which is a response to the COVID-era supply chain disruptions. As you can see from the graph, both Mexico and Canada have now surpassed China in terms of largest trade partners with the US. We predict that this trend will continue and will increase costs to businesses as moving away from a low-cost region like China. Additionally, We think inflation will be supported by elevated energy prices due to things like OPEC production cuts, CapEx by big oil companies being reduced to return money to shareholders, and conflicts overseas. To fight this inflation battle, we think the Fed ought to keep rates higher for longer. Add this to the fact that we believe effects from the previous rate hikes have not yet fully been felt by the market. We think there are certain sectors that we can profit off of and certain sectors that we wish to avoid, which we'll discuss now.
Thanks, Will. So 2 sectors that we see opportunity in are consumer staples and healthcare, and 2 sectors we're looking to avoid are consumer discretionary and information technology. Within staples specifically, we observe that high-yield credit spreads are near pandemic-era lows, and we see little room for them to continue to narrow. Fidelity research has shown that as credit spreads widen, consumer staples tend to outperform the broader market, and this dynamic was on display in 2022 when the broader market was down 18% as spreads widened, while consumer staples remained relatively flat, only being down 60 basis points. Additionally, we observed that consumer staples are cheap relative to historical averages, and as such, we think most of the risk has been priced out of the market in the consumer staple sector, and think it seems ripe with opportunity.
Thank you, Eric. Well, now moving on to healthcare. The U.S. population is not only getting older, it's also getting unhealthier. And while recent news regarding GLP-1s have some in the market believing that we have found a cure for all of our healthcare problems in the United States, such as obesity, diabetes, we believe that the market has overreacted in the short term and has left us ripe with opportunities for overlooked securities in the sector. One of our proposed holdings, Dexcom, illustrates this perfectly.
Thank you. So now moving into areas to be cautious with consumer discretionary. In consumer discretionary, we see undue risk due to rising credit card debt and delinquencies in the U.S. We take this as a signal of a weakening consumer, despite many companies reporting strong earnings, which we believe to be artificially inflated. Moving forward into information technology, we continue to believe that the valuation, especially those of the Magnificent Seven, are unjustly elevated and unfit to our risk appetite, especially after a weak performance in Q3. We see similarities in the AI trends this year and the Gartner hype cycle, which attempts to explain the life cycles of emerging technologies and the relative financial performance. We see AI approaching the downfall point of this cycle.
Thank you, Keyshawn. Our economic house view has led us to determine that the pictured asset allocation is most appropriate for CSU Smif moving forward. Our portfolio will have 59% of assets under management allocated to U.S. equities, 34% allocated to U.S. fixed income, 5% allocated to international equities, and 2% allocated to cash. You may be questioning how we came up with a 5% allocation to international equities. Instead of straying away or steering towards international equities, we prefer to allow our bottom-up stock picking to drive the allocation.
Now on to our investment process. So our investment process boils down to 3 key pillars built on a foundation of evidence-based decision-making. All of our securities are evaluated and priced using bottom-up fundamental analysis driven by quantitative and qualitative research. When given the opportunity, we will always opt to actively manage our portfolio, driven by tactical asset allocation and bottom-up security selection, all while limiting the usage of ETFs and reserving it for special situations such as when one of our securities reaches its stop loss. And finally, we follow a cohesive strategy in line with our economic outlook in order to achieve our goals. Now moving on to our idea generation process. It's important to note that this process is not linear or one-size-fits-all. All of our ideas come from It's important to note that this idea generation process is not one-size-fits-all. We recognize that there is no single metric that can cover the entirety of the stock. So with that, we strive to thoughtfully evaluate and decide how we evaluate our stocks, identifying the key metrics and fundamentals in order to choose the appropriate valuation technique.
Thank you, Kirsten. We at Cal State Fullerton also utilize risk management as a part of our investment process, both before and after a trade is added into our portfolio. Prior to the trade, we analyze our economic outlook and try and determine how we believe a given company will perform in the current environment. We also perform correlation analysis to try and determine how a given trade might affect the diversification of our entire portfolio. Once a trade has been added into our portfolio, we continue to monitor the critical risks of the company as well as the fundamentals and the competitive advantage among the industry to try and prevent the permanent loss of capital, as well as performing regular leaders and laggards of both sectors, asset classes, our portfolio, as well as the benchmark to try and determine why the trend in prices has performed that way, as well as whether we believe it will continue.
Now looking at our fixed income portfolio. So what are our plans for the fixed income portfolio? Well, for starters, we see ourselves increasing credit quality and duration to slightly above the benchmark while reallocating funds away from high yield corporates into investment grade corporates and treasuries. We believe that this reallocation will put our portfolio more in line with our economic outlook as we look to insulate the portfolio from possible widening of credit spreads while also generating price appreciation should the Fed lower rates in response to a weaker economy. We intend to keep an approximate 2% cash allocation, which we will continue to invest gradually as we collect distributions and dividends from our current security holdings. So how do we pick the best bond fund? How do we determine it's the best bond fund for us? Well, for starters, we start by screening for the most attractive duration and credit quality positioning in alignment with our economic outlook. We look at key statistics such as Sharpe ratio, standard deviation, information ratio, and upside-downside capture, while also dissecting the holdings of the fund in order to make sure it's what we see and in line with what we deem appropriate. Following this, we look at performance consistency and management turnover on a 3-year, 5-year, and 10-year basis to ensure that past performance is not an anomaly and that management will remain true to their process that's worked so far. Now, these changes won't just happen overnight. They'll happen gradually over the course of a few months. With that being said, we would like to highlight one of the bond funds we intend to purchase, which we have identified using this process and which aligns with our goals.
Thank you, Jeff. Like you said, we've implemented this process when identifying an attractive, actively managed bond fund. Through our analysis, we managed to identify the Dodge & Cox Income Fund. Compared to its peers, it has an attractive duration and credit quality given our economic outlook. The fund has also provided consistent returns over its track record, participating well in up markets and avoiding significant market drawdowns. The management team also has a tenure of 17 years, and this, combined with other factors, has led us to determine that we would like to allocate a portion of our portfolio to this fund.
Thank you, Jacob. Now onto our equity portfolio. We believe our allocation produces a significant amount of our competitive advantage. First of all, we look for things like high ROIC and cash flow conversion rates, in combination with secular tailwinds and short-term dislocations. With this strategy, we believe we can get favorable entries into amazing stocks. Additionally, going into our risk management strategy, we are in line with our defensive outlook. We are markedly lower on beta than compared to our index. Moving on to our broader sector allocation, we do not tend to allocate based on our macro outlook in sectors, but reference our bottom-up approach. However, we will use our broader outlook as a guide stone, and we'll pay attention to the interest rate environment and make sure to avoid sectors with long-term headwinds. In terms of individual stock allocations, we will still look for short-term dislocations, value and pricing power, and value conversion. For those reasons, we are notably underweight in technology while being overweight in healthcare and consumer staples.
Speaking now on our process for individually selecting our equity securities, we first begin by asking ourselves, the million-dollar question: how does this company make money? We then move on to understanding the industry and the company's positioning in this industry by conducting a Porter's Five Forces analysis, a SWOT analysis, and running the company through a peer comparison spreadsheet that we created. We also then identify key value drivers to better understand how the company will perform moving forward. And finish out by evaluating the security using a DCF model, multiples valuation, and/or a 3-statement model when appropriate. I'd like to now discuss some case studies when this process performed favorably and unfavorably. Speaking first on Chipotle, we purchased Chipotle earlier this year, and for the holding period, we're up approximately 19%. This is mainly attributable to 2 instances of earnings beats. Our original thesis held that Chipotle would be able to transfer costs to customers well and improve comparable same-store sales, which held true. This is mainly due to the modularity of their menu, allowing for the swapping in of higher margin items like carne asada. An instance where this process didn't perform favorably was in Builder's First Source. We were stopped out of this position in late October because we were underwriting to the outer bound of our investment horizon of 3 to 5 years. We lost sight of the short-term price volatility and the need for stop-loss monitoring. However, moving forward to correct this error, we will be implementing a new board position, the Chief Risk Officer, who who will be in charge of stop-loss monitoring and communicating with sector teams to monitor each company in the portfolio. We'll also be implementing a stop-loss warning function to help us track this on a quantitative basis. I'll now turn it over to Eric to discuss our stock pitch on Kenvue.
Thanks, Tom. Our investment thesis is quite simple. We believe Kenvue stock has been oversold due to the recent spin-off from Johnson & Johnson. We see an opportunity to own a portfolio of high-quality consumer healthcare brands, trading at a discount to fair value and peer multiples while offering a 4% dividend yield. Our weighted scenario price target of $23 per share sees 19% upside as of the most recent close. Pictured on the left is Haleon, a comparable spin-off from Pfizer in July of 2022. Notably, it took Haleon stock 3 months to reach its post-spin-off trough, whereas Kenvue stock has taken 5 months and is yet to fully recover. A study by Penn State has found that spin-offs generate significant positive abnormal returns, typically in the second year following the spin-off. To reiterate, we see an opportunity to buy a portfolio of Tier 1 consumer healthcare brands at a discount to fair value. As of 2015, Kenvue owned nearly 35% of the OTC painkiller market, despite the premium pricing of its brands and rampant competition from generics. We think this gives them a wide moat and enviable pricing power in an otherwise undifferentiated industry. This is translated into robust financial performance with operating margins in the 18 to 22% range. Also notably, our projections are below the street and we consider them to be conservative, giving further credence to our 19% upside. Furthermore, Kenvue is a well-diversified business, and while this has given them some short-term headwinds in the form of foreign currency exchange rates, ultimately, we see their diversification as an asset, not a liability. Of their 3 lines of business, self-care stands apart as it's the fastest growing and highest margin. The CMS indicates that it believes national healthcare expenditures will outpace GDP growth going forward, providing Kenvue with favorable secular tailwinds. So, to conclude, CSUF recommends a buy for Kenvue stock as our weighted scenario price target of $23 per share implies a nearly 19% upside to the stock. Thank you. And we would now like to discuss our historical performance. So we'll just talk about this really briefly, and then we'll kind of open it up to more questions in the Q&A. But we lagged the benchmark year to date mainly because we were underweight tech, as we didn't see opportunity for good risk-adjusted returns in the sector. We'd like to point out, though, that this has been more favorable for us recently, as you can see in our 1 and 3 month returns. Furthermore, our underweight to financials early in the year, especially during the regional banking crisis, also helped our portfolio as well, as we tended to stay away from areas where we saw high risk in the market. Within our fixed income portfolio, we've remained underweight the benchmark in terms of duration and credit quality, which has led to meaningful outperformance, and we can talk about that more in the Q&A section as well. We now like to open up the floor for questions.
Nice job, guys. Very clear. Appreciated the case studies. I think it's always helpful to be realistic and kind of acknowledge what's worked, what's didn't. Music to my ears. I shed a little tear when you guys said that you were nominating a new position to specifically oversee stop losses. I think that speaks volumes to your understanding of risk controls, oversight, and that's been a pain point, I think, for all the teams, because it is a lot of work to maintain that. So really, really love to hear that you guys are dedicating a role to that. My question for you is on the decision to be underweight technology. I think the reasons that you gave were the year-to-date rally and the Magnificent Seven. I think acknowledging that not all of the stocks in the Magnificent Seven fall within the tech sector. So did you guys consider maybe an equally weighted approach to the technology sector as a way to maintain that exposure without kind of chasing those kind of high flyers that have run up already?
Yeah, so we see a lot of valuation risk in tech right now. So even if we're not buying like the Magnificent Seven, those stocks have kind of pulled up the index overall in a lot of technology games. So we don't really feel comfortable trying to generate risk-adjusted returns if we're chasing after technology stocks.
There's also an opportunity cost, resources, and time element to it. So if we see opportunities in other sectors that we'd rather pursue, rather than dealing with some of that risk, we think it'd be better spent to just pursue opportunities in other sectors.
Understood. I would say, pointing out too that the reason that you guys underperformed this year was underweight tech. So for your sake as well, I hope that doesn't happen again next year.
Question around healthcare. I understood your macro view to be that there's continued inflation going forward. How do you think that impacts your healthcare holdings specifically?
I think a lot of our healthcare holdings, or at least the ones that we had proposed so far, have demand that tends to be relatively inelastic. The holdings, for example, like Dexcom. Diabetes, you can't choose whether or not to monitor your insulin. You have to. And as well as I think we proposed Edwards Life Sciences as well, the products that they make aren't necessarily correlated to the greater market as a whole. If there's people that need heart valve replacements, I think that that's insulating a little bit from general trends.
Healthcare is also pretty heavily subsidized by the government, so we don't see a whole ton of risk in terms of consumers killing back spending.
Basically, I like your emphasis on the risks while people chasing for yields and the total return, they easily forget about risk. So I want to, can you elaborate a little more what other risk metrics you're looking at, and how those metrics, how you interpret those metrics to impact your portfolio? What's the process you control those risks?
Yeah, so I could take that. Some of the risks that we look for when we're doing bottom-up analysis would be balance sheet and the strength of the balance sheet, whether or not the management team has consistently created shareholder value. We also look at the given benchmark as well and determine by the exposures where our benchmark has given risk and where we are allocated sector-wise from a risk perspective. We also look at margin of safety when we look at bottom-up stock selection. So how much do we have from the upside of a given security compared to the downside, as well as reevaluating our thesis after a position has been in our portfolio for a given amount of time to determine whether we still have the same conviction on those securities or if we believe the trends around the company have changed.
Were you asking more in regard to individual measures of risk or just like general themes of risk?
I just want to know a little bit more details of what are we looking in terms of the risks.
Yeah, absolutely. I think one of the things that we've discussed a lot this year is that we prefer information ratio as a better measure of risk as opposed to the Sharpe ratio, just because it has a better understanding of downside as well. We've talked about that at a bunch of board meetings this year, so that's just something to point out. I think.
Given your, I guess, more sanguine outlook, can you comment a little bit on the discretionary weighting? You're pretty overweight there too.
Yeah.
So within our discretionary holdings, we have Starbucks and Chipotle as kind of two of the biggest ones. And we would argue that despite the gigs classifying them as discretionary, they're more staples. I mean, how many people, go to Starbucks every single day, and it's not really something that they're going to cut out of their daily budget. As well as Chipotle, it's a pretty affordable product. It's like $10, $12 for a bowl or a burrito. We think that those are more considered inelastic discretionary.
Another component of our discretionary exposure is auto manufacturers and Toyota, to name it. But we see there being some secular tailwinds there with the trend towards hybridization and electrification. We see some competitive advantages for them.
I like how two colleagues recommended Chipotle. I'm getting hungry. I need a bowl.
Is the entire fixed income allocation invested in Belgian stocks, or are there positions that are around that?
Oh no, that's just one of our recommended allocations. There's other positions in there as well.
Can you show those to us?
Yeah.
Or discuss them at a high level?
Yeah.
So some of they're all funds, of course. So what we have right now is a diversified portfolio between, most of them are going to be A or AA with only 2 BBB. Some of them are shorter duration, which is what's bringing down our overall duration for the portfolio. But right now, as mentioned, that we are trying to increase that duration just because we don't necessarily see that maintaining a short duration is favorable right now going forward. but we also don't see that we should aggressively hike up our duration, especially with the volatility that we've seen in the past 2 months. And with the Fed possibly maintaining rates higher, it seems a little premature. We're not necessarily in the predicting business, but it seems premature to try to increase duration very quickly.
Thank you.
Maybe on that question, are the other funds that you've selected, are they active, passive, ETFs, mutual funds?
For the most part, they're going to be passive, and there's a handful of active, or I'm sorry, there's about 2 to 3 active ones in there. So we're still reviewing to make sure that they're actually managing that versus just saying, hey, we're going to let them ride for how they do. We want to make sure that everything in our portfolio is being treated properly, even what's out of our hands.
There's a good mix, I'd say. I think actually the fund that we're proposing that we sell out of to replace it with the Dodge & Cox fund, we were uncomfortable with some of the holdings of the strategy. We were essentially buying a treasury ladder that they were charging like 65 pips for, so we thought that was an inefficient use of our funds. We'd rather allocate something to
Can I see that slide where they had the managers on there?
Yes, yeah. This is the peer comp for Onyx, I believe. This isn't our current holdings. This one. And just a quick comment on the duration. Obviously, given our economic outlook, you might be asking yourself, like, why are we picking the shortest duration out of these funds if we're trying to extend our portfolio duration? Based on the other factors, we saw that this was probably the most attractive of the funds, and also the fund that we're replacing it with, we're using it to replace in the portfolio currently, has a similar duration, so the effect overall will be to increase our portfolio duration.
The way that we determine these, we're still looking at the Core Plus with a lot of them holding similar holdings, treasuries, and investment grade corporates. But we also want to, again, mention 3 to 5 year and 10 year basis. We also want to see how they perform over that course or over that time span. So that's how we also came up with this as well.
Any other questions? No? All right. Nice job, guys. Thank you.